Hey there, everybody. This is Ron Evans, and I wanted to come to you today. I think I promised in a previous video that I would get around to talking about your debt to income ratio. If you are looking to buy a home, this is something that you really need to have a decent understanding about because it's going to be one of the biggest factors at how your loan is approved and the types of terms that you get on the loan approval. Now, different loans and different loan products allow different debt to income ratios. I'm not a lender, so I won't talk in specifics in that regard. However, if you do have questions that I don't talk about here or that are more lender suited, just let me know. I'll refer you to a great guy you can talk to and get those answers. I just want to make sure you understand what goes into calculating your debt to income ratio so that you know when you're trying to budget your bill, your monthly bills, and you want to try to afford a house, you know what the bank is going to be looking at when they go to approve you. So how to calculate your debt to income ratio? If you're in the market to buy a house, which if you're watching this, hopefully you are, or you will be soon, your mortgage lender will look at a couple of main factors to determine if you qualify. Most people know that they check your credit score and credit history. Hopefully you know that, but they aren't aware of the debt to income ratio and how it works. So first, let's answer what is a debt to income ratio. Your debt to income ratio, or DTI, is a comparison of your monthly debts to your gross monthly income. That's your income before taxes. It's very important that you understand that. The higher their percentage is, the higher your risk of default becomes in the eyes of the lender. Lenders like borrowers with a debt to income ratio of 43% or less. Now, like I just said earlier, there are different banks and lender products available that have different allowable percentages of a DTI. For a conventional loan, a standard conventional loan, that 43% probably rings true, or right around there, 43 to 45. But there are some other government-backed loans that maybe Fannie allow, or Freddie allow, or FHA or VA. They may allow 50% or higher. It depends on your credit score. A lot of the times this is all kind of a floating chart, if you will, of things that you qualify for and terms that you qualify for based on all those different risk factors. So if you have a really good credit score and really good income, they may allow a higher DTI. If you have a lower credit score, they may not allow you the higher DTI because they're only going to put so much risk out there for your loan. So this leaves plenty of money for living expenses and savings, reducing the risk of default. What is included in your debt to income ratio? The only information you need to calculate your DTI is your total debts and total income. Here are some examples of debts to include in your DTI. First of all, it starts with your credit report and what shows on your credit report. A few examples might be your car payments, minimum credit card payments. So not what you normally pay. You have a $10,000 credit card and your minimum payment is, let's just say, $100 a month. That's what you're going to include as the $100 a month. If you're the type of person that pays more than that, like, $200, $250, $500 or more, because you don't like to carry a lot of debt, that's not the number that they are going to use. They're going to use what your minimum payment is that shows and reflects on your credit report. Any personal loan payments you have. So if it's on your credit report as a personal loan, that's going to show up in your DTI. Also, your student loans. Some people completely forget about that kind of stuff. There's always some question on, well, if they're in deferment, how long is the deferment and things like that, on if they get calculated or not. That's a lender question, not a Ron question right now. Your DTI also includes the new mortgage that you're going for. Okay, so if you're If you have a current mortgage, you need to work in what your replacement mortgage is going to be if you're selling your old house to buy a new house. If you have no mortgage at all, if you have rent, now you're going to replace what your rent is with what your new mortgage is going to be in your DTI. But don't forget, not only does it include principal, interest, property taxes, and homeowners insurance, which is what we normally call PITI, it also includes any HOA dues, any mortgage insurance. And remember, if you have a lower down payment, if you're on an FHA loan or a low down payment conventional loan, you may have PMI, which is private mortgage insurance. All of that gets included in your DTI. Now, what do you include for income to calculate your DTI? You can include any income the lender will use for qualifying purposes. Obviously, if you have a full-time job and you're a W-2 employee, that gets included. But if you have other sources of income that have a 2-year history and will continue for the foreseeable future, you may include them too. Common examples include alimony, child support, any side gigs that you work regularly that you can show that 2-year history and that you're going to have future income. Maybe you do contract work and consulting on the side outside of your normal W-2 job or your normal career job. If you can show that and you've got the history and the future coming up with it, you can include that in your DTI. If you have other income properties, let's just say if you have an obligation on that income property, like you owe debt on that income property, but you also get rent in, obviously, that both of the sides of that can calculate into your DTI. So if your income coming in exceeds the debt you have going out on that income property, that would be a positive for you. Now, calculating your DTI. With the two totals we talked about above, your total income and your total debt, you can calculate your own debt to income ratio using this simple calculation. Now listen and write this down. Total debts divided by total income equals your debt to income ratio. I know the whole thing sounds like it's crazy to try to figure out on your own, that you need to have an abacus or a math degree or what have you to figure it out, but it's really that simple. Total debts divided by total income equals your debt to income ratio. Now, for those of you that are visual and you're looking to figure out how to set up the math problem to divide it, that's total debts on top with the slash, and then your total income down below equals your debt to income ratio. Here's an example. Jan makes $7,000 a month before taxes. Her debts include the following: minimum credit card payments of $150, car payment of $300, student loan payment of $250, new mortgage payment of $1,750. That's $1,750. Jan's debt to income ratio sets up like $2,450 divided by $7,000 equals 35%. Now that's a very simplistic look at how to set that up and a very simplistic example. Most of us here in Orange County or Southern California, or really in a lot of other places of our country right now, we're not dealing with nice, easy round numbers like that and low debt to income ratios like that. That's just an easy way to set it up so you understand how to calculate. Now, there are ways if you start to calculate your debt to income ratio and you're like, holy cow, I'm at 45% or I'm at 48 or 50%, and you're looking at the types of loans that your lender is going to now offer you based on those DTIs. There are ways to lower your debt to income ratio. Obviously, if you lower your debt to income ratio, if your debt to income ratio is higher than a lender might like, here are a few ways to lower it. Number one, pay your credit cards down or off. If you have credit card debt, try to pay it off. If you can't, at least pay them down so your minimum payment drops and you lower your DTI. Some people don't realize that the balance they carry on their credit card debt affects their minimum payment necessary. So if you have a $5,000 line of credit and you've got $2,500 on there, your minimum payment might be $170. But if you can pay that down to where you only have $1,500 balance, it's going to recalculate and reset, and maybe it brings you down to $100 a month. Look at the terms and conditions on each credit card that you have to know which ones that you pay down and how that will affect your minimum monthly payment. And when in doubt, call the credit card company. Pay down other debts that you have. If you have other consumer debts, you can pay down to have less than 6 payments. Lenders may exclude them from your DTI. That's very important to know. Say you're making payments on a car and you've owned the car for 3 years and you had a 4 or 5 year loan. Well, maybe you can make a chunk payment down on that car to where you only have 6 or fewer payments left after paying all that down. Well, they may not now include that car payment in your DTI because you don't have very much longer to pay it. Make sense? Increase your income if you can. If your income is too low, take a part-time job, take a gig job. You'll need to show the receipts of income for a while. So the sooner you start it, the better. You may not need a full 2 years depending on your lender and the program you're going for. A shorter time period may be fine, as long as you show consistency with the deposits and the receipts for the money you earn going into your bank account. Final thoughts. Your debt to income ratio is just as important as your credit score. A lot of people don't realize this. Take time to figure out your DTI. Please take the time. And where you stand before thinking about buying a house. You can prepare both your credit score and your DTI early on to increase your chances of loan approval. Now, pull your credit first. Go to something like freecreditreport.com or myfreecreditscore.com. There are lots of ways you can pull your credit report for free annually. You get like one a year without having to go to a lender first. This is work you can do on your own. Obviously, it's a little bit easier and nicer if you go to a lender first, because they can set things up for you and maybe put you on a program to success. But if you just are at that point of, should I buy a house? Can I buy a house? Can I really afford what I think I can afford, or maybe not? Do some legwork yourself. All it costs you is a little bit of time. You can do it all for free. Pull your credit report, look at all of your obligations on your credit report, then pull your W-2s for a certain amount of time and calculate what your annual income is, especially if you're working hourly and not salary, or if you don't have a contract or what have you. Figure out what your annual income is before taxes, not your net, before taxes, and figure out what your DTI is. You'll achieve 2 things by doing it that way. Number 1, you'll know what your credit score is, so you'll know where you're going to fall as a credit risk. And number 2, you'll know what your DTI is, so you'll know where you're going to fall in that kind of a risk. But once you've accomplished both of those things, you're going to make your life so much easier when you go to buy your house. As always, if you have any questions, please send them to me at realestate101@ronevansrealty.com. Drop a comment below if you're listening on my podcast or if you're watching on YouTube. Either way, drop a comment. I will respond. Or you can send me a text message, 949-929-2270. Talk to you again soon.